Hi everyone, this is Max from ONG Capital. I hope you all had a great Mid-Autumn Festival. Right now we're 10 years into a bull market, and with that in mind, we're going to talk about 4 ways to invest in a mature bull market. So here we have a diagram that allows us to compare companies on 2 axes. We have expensive versus cheap, and great quality versus low quality. Based on this line right here, we have worse value on the left and better value on the right. So ideal world, we're right here, right? We can find an excellent company trading at a really cheap price. Unfortunately, the fact of the matter is, in this sort of market environment, that type of profile is almost impossible to find. So today we're going to talk about the 4 most prevalent ones you can find in this market. Number 1, low quality companies that are very cheap. Number 2, good quality companies trading at good prices. Number 3, great companies trading at fair prices. And number 4, expensive companies in which their quality is unknown. All right, the first category we're going to be talking about is low quality companies that are really cheap. These are companies that are going to be characterized as, possibly in a dying industry or might have shrinking margins. Now, price can be tempting here, but in the end, quality does prevail, so you need to be a little bit careful. A good example, you look at the brick and mortar retail industry. You have a company like JCPenney. It's really been struggling with earnings over the past few years, but last year at $12 a share, it looked cheap. It still looked cheap at $6 a share a few months ago, and now at $1 a share, it still looks cheap. So investors at any point over the past year would have pretty much lost all their money. Now, you can make money with turnarounds, but it does require some expertise. It requires a lot of time and energy, and it doesn't quite have that profile of the buy and hold that a lot of people are looking for. All right, the second category I'm going to be talking about are good quality companies trading at good prices. So right around here. Now you might be asking, how can a good quality company be trading at a discount in an otherwise inflated market? This is usually going to have to do with a short-term external event affecting all companies in an industry or perhaps in a geographic location. As an example, you can look at the interest rate environment in the US over the past year. A lot of uncertainty sort of been in flux, and it's led to a lot of the banking stocks and financials to come off quite a bit. They've since rebounded. However, there are still some good pockets of opportunity in that sector. All right, the third category we're going to be talking about are great companies trading at fair prices. So right around here. These are the companies you buy once, never have to worry about. You can give them to your grandchildren. So we're talking good dividends, good track records, and great industries. You can sort of think of them as the long distance runners in the Olympics, just super steady. Now, because of all of these positive attributes, you're usually going to be paying a premium for them. But with a long-term time horizon, that premium is well worth it. You can think of the Johnson & Johnsons, the Procter & Gamble's, just companies you can buy once, put it in the safe basket of your portfolio, never have to worry about it. All right, the fourth category we're going to be talking about are expensive companies in which the quality is sort of unknown. So anywhere around here. So at any point in a market, there's going to be companies working at the cutting edge of the given innovation or technology of that time period. In the early 2000s, it was the internet. Today, it's things like 5G, fintech, and cryptocurrency. These are going to be small companies that are growing revenues really quickly, but not yet profitable. Because of all the potential, all that revenue growth, they're going to be expensive. There's going to be a premium attached to them. But because of the lack of a track record, it's hard to say whether or not they're going to be successful or not. So if you're going to invest here, keep your allocations small and make sure they're diversified. In summary, these are the 4 investment classifications we talked about today. We have low quality companies that are super cheap. Exercise some caution here because in the end, quality prevails over price. Numbers 2 and 3 are all about buying quality at a reasonable valuation. This is where we spend the majority of our research hours and the majority of our allocations. The fourth is expensive, in which the quality is uncertain. Keep your allocations diversified and small here. So, hope you guys enjoyed watching, hope you learned something. I urge you guys to look at your own portfolios, see where your allocations line up. If you have any questions, please reach out to me on WeChat or send me an email.